All right, now to our first conversation. And our just manufacturing sector grew by 5.89% year-on-year in real terms in the first quarter of 2022, an increase of 3.61 percentage points from the preceding quarter, which recorded a growth rate of 2.28%. Well, let's discuss this and other issues in the manufacturing sector. Joining us now in the studios, Mr. George Nofowoko, MD, CEO, Coleman Wires, join us right here. Great to have you. Good morning.
Good morning, Laddie.
So, the last time we had a conversation on this set, there was no war in Ukraine, and inflation was not a global issue, at that time, but it was rising, but now it's all everyone talks about. So I'm wondering, how is all of this impacting your sector?
There's no market where inflation is at the level at which we are. If you look at last month's level, which we're now almost heading to 17%, we're talking 16.82% with a movement from April of 15.8 or 9 thereabouts. So you have almost a 1.9%, almost a 1% basis point increase in inflation, almost month out. There's no market that is good. Inflation levels, of course, we will have preferred the single-digit inflation level. But if you look at what is impacting, food is impacting it. We're having also real factors, consumer goods, your petrol, your diesel prices have gone up. And those are impacting real sector. And in that variables, when you look at the last 2-3 months, for instance, just even taking diesel moving from all-time high of 400 now to an all-time high of 800, then coming back to stability of 700. Those are impacting inflationary figures. It is not good for manufacturing, but unfortunately, we are in the world we're in today with what happened in Ukraine in February. We could see what happened instantaneously on food prices, maize coming out of those areas, grains coming out of those areas, steel, aluminium for people like us, and copper coming out of Russia. Now, those impacted the figures instantaneously. Now, you saw all indexes going up, including commodity prices going up all over the world. And for instance, you had a copper jump from close to about $8,000, they're about $9,000 to an $11,000 high, all between the war series. So, unfortunately, we're dealing with too many crises in the world at the same time, post-COVID. And that everybody is expecting life to go back to normal. Then the war starts and everything impacts our figures. It's impacting us negatively. There's no doubt about that. Inflation basically means our buying power starts reducing. The faster it grows, it's not in our interest. That is what we see with the impact of MPR finally actually going up because it's now moving too fast. And for us, the manufacturers, yes, we're seeing growth. Nobody's doubting that. Everybody in the world saw growth post-COVID. You don't close down a world for 2 years, then you wake it up. You wake it up instantaneously, growth will. Inflationary GDP figures for most countries were at the highs of 6, 7, 8, 9, 10%.
It was normal for them to pick up.
Yeah, it was normal for them to pick up. So the key thing is now we're having a knock-on effect of a pickup now almost being stagnated by inflation, impacted by what is happening in the world with Ukraine, what post-COVID was supposed to bring. And for Nigeria, for a country like Nigeria, not only Nigeria, Africa, we're a country dependent on importation and a continent dependent on importation. So the impact of those importation and the impact that that happens to them in the world does directly impact us. And those are what sees those indexes change. Negatively in the case of manufacturers, positively in some other people's cases where you're doing financial instruments. Now, but where do we go from here? That is the question now. That's the question.
So, now, with recently we've seen all central bankers, globally, most of them are raising rates at this point. We had the expansionary, policy from the central bank right here in Nigeria, but the last meeting, we saw a rate hike, and we've got mixed reactions, coming from that. But really, how is that impacting or how do you see it impacting your industry?
Negative.
Now you have to borrow at a more, expensive rate.
No, the sad part is, And this is Nigeria for you. Sad part is NPL goes up. The day it goes up, literally look at the letters you get from your banks within 24 hours to a maximum of 48 hours. You will get that letter. It's almost a week. They don't sleep. As if we wake up, we see NPL go up, we send our letters to our customers telling them NPL has gone up 2%. So therefore, all our rates are going up 2% or more. Now, if NPL goes down, they all go to sleep. That's the reality. Now, so we're getting we're getting instantaneous impact of that. It was inevitable. Inflation cannot be rising up at about 17% and NPL rate staying at about 11%, 11.5. It wouldn't be, the gap is too much. Now, one thing that is also good is that because we've seen inflation at this level, we have to commend the developing banks and both central bank and both Bank of Industry that have literally tried to soften the blow to the manufacturing sector. So where you're actually having the intervention rate going on. And the intervention rate, to be fair on them, is still a post-COVID rate at 5%. And that doesn't end till end of February next year. So you have the 100 for 100, you have the DCR, you have the Bank of Industry, Central Bank, Industrial Funds. All those things are still going on. Most of the manufacturers are all beneficiaries of it. They cannot say they're not. So there's cushioning blows. So we cannot knock what is happening without saying we're trying to create cushioning blows. Now, it's those cushioning blows that are seeing those effective rise in manufacturing indexes. So, because when you're having enough cushioning blows, you are able to actually still secure the right amount of financing. So, financing, even for a manufacturer, is a case of average. What is my average cost? My average portfolio of funds. Now, if I go to my commercial bank, which is killing me with higher interest rate, I don't want to mention the figures because...
The real figures.
They're going to call me the next minute and say, Mr. Nofoko, are you enjoying that same figure or the rest? Now, so I don't... But the real figures are definitely in the double digits, in the higher double digits of the... close to, you'll say, between 16 to as high as 25, 28, depending on the manufacturer. For trading businesses, it can go as high as 30%. So those are the realities. Now, the key question is, how much of those intervention funds do you have with a blend of the higher interest rate to blend your average rate? Now, as long as our average rate continues to be sustainable, most manufacturers will continue to purchase. So the inventory figures will go up, which is why you're getting the PMI figures, the Purchasing and Manufacturing Index, actually going up 51% to 54% as we see it now. But the key question is, what also, there's a flip side to manufacturers buying more. Yes, the market is moving, the market is getting better, but the question also is that they could also be projecting inflation risk at the moment. So you're seeing prices rise. So what do? You buy more and stock it against the price shifting to your customers. So you're finding out that most manufacturers are now buying literally forward of their projection of the risk that they associate to prices going up. So I see maize going up and I need to use maize for my manufacturing. Instead of me buying 100 tons, I buy 500 tons. Now, I stabilize the prices because I bought enough to take me maybe the next 3 months. But then the cost of finance is now playing a part.
That impacts your cost of business.
It does. There's no way. The inventory cost is going up. So if you look at that, yes, manufacturers are buying more. The market is moving more. But we're indirectly turning ourselves to bankers. Yes, that's what to say. If you look at the amount of stock you're carrying, our inventory level, safety level, for instance, for ourselves, can be as high as 6 months. In some cases, as high as 9 months. So if you're taking inventory stock of 9 months, you take the financial cost of a 9-month stock rolling into in every manufacturer's warehouse. We're a bank. So billions and trillions of money is tied up in inventory unnecessarily because we're all speculating two major things: inflation, gap, movement risk. We're also looking at the FX risk. So FX today, FX tomorrow moves 5, 10, 20%, and it's
the
galloping.
FX is another huge elephant
It is.
in the
So
room right
you
now.
find out that the index is looking up because the manufacturers invariably in Nigeria, out of what they've seen post-COVID and pre-COVID, pre-COVID and post-COVID, they started literally turning themselves to banks. Now, so when you look at most figures of most of the companies today, their stock levels is higher than they used to carry 3-4 years ago.
So can consumers, be rest assured that, prices won't go up that much with all of this?
I think it wouldn't. In my own view, if you look at the Nigerian trend, inflation moves up, food prices move up, but look at the manufacturing indexes. They don't move up at the same pace. Because what has happened over the years, especially in the last 5 years, is that manufacturers themselves have become strategists. So they moved away from just literally manufacturing to literally having financial strategy, inventory strategy on all their businesses, budgetary planning for what you're going to buy. It's literally a whole working experience on its own now. Because if you don't, and your product is not elastic enough for you to keep passing on these prices to your customers, it will get to a point you shut down. Now, which one pays you better? Take some extra financing costs, manage price levels throughout the year. So Nigeria, we're lucky that the manufacturing sector has so been battered over the years that they've turned themselves to an holistic business. They're their own government, because they own all their infrastructure, their power, their sources, their own financial department, they have their own treasury department, and they're literally occupying almost every area of business.
How sustainable is this, really?
For an economy like Nigeria, it doesn't look like it's sustainable, but it's become the norm, the new normal. And really, if you go to any business in Nigeria today, and literally, they don't have almost all that department sitting in, you won't find them being very successful. Now, so you find that their bank, they understand treasury and treasury management and money management as well as their bankers. They understand the policy and instruments of policies, both fiscal and monetary policy, as well as any person in CBN or Ministry of Finance. But really, that's not our core business. But we have turned ourselves into, you look at me, I'm sitting here now, I'm a core manufacturer in Nigeria for over 25 years, and I'm talking economics.
Right.
But we're a very big manufacturer. We'll be successful because we have blatantly looked not only in the manufacturing sector, we've looked at what balances manufacturing. And financial instrument understanding is a key factor to getting this manufacturing going. And manufacturing is doing better because we've changed our mindset and decided to be what everybody doesn't think we should be, but now understanding and accepting that it's now the norm, that if most people advising or advisory companies sit with you and they see you don't have this vast understanding, or the company doesn't have this risk elements that they are actually mitigating, the tendency of you getting into trouble is easy. So right. You don't mitigate the risk for FX, for instance. FX,
talking about FX now, we've seen that cross the 600 naira mark in the markets we don't like to talk about.
You know what?
Handling that?
Oh God, I think I said this to some of the, because I'm part of mine and I sit in some of the committees. And one of the things I said to them last time, I said, look, we're fighting a wrong fight. The reality is that we're all sitting here, most of the manufacturers, big and small, have already priced in these figures we don't like talking about, parallel market. The question is, when is the government going to be bold enough and just narrow this thing into one single digit? Because we're literally penalizing the economy and the masses and the consumers. Now, I'll say that because you're talking of that parallel market figure. There's some products that you just cannot get. The elasticity of this product, there's no matter what price you call it, everybody's going to buy it, right. Especially food-rated ones. Now, what can you do in that scenario. So what is happening with most of those manufacturers? They're buying their raw materials at whatever the going rate is, whatever they can get the inflow rate is. Now, how do we change that dynamics? I need to be able to source funds, whether from the central bank is saying, yeah, we're going to move away from central bank influencing that figure. Let the commercial banks influence it. But they must be able to source it. So let's have a single window. In my own impression, a single window naira today is definitely not the figure we're saying. Far less than that figure. Now, how less it's left to you allowing the exporters to move their prices as they like? Because if I'm an exporter of cocoa today, or processed starch, or glucose, whatever material I'm exporting, I need to be able to trade it at whatever prevailing market is. So the windows have to change to one single window, allowing free market movement. It will impact us, but it's already impacted us. If I'm telling you that we're all not thinking about what... Because I want to buy machinery. Okay, today we opening up a fiber optic cable factory. And we're also opening up a gap cable for transmission. But now, if you look at those two things, fiber optic is not available, but everybody is using fiber for data. Now, key question, how do they buy it? They're buying it on FX. I spoke to some of the big players in telco, and they're telling me it is terrible for them to get some of this material.
Right. So much to so much to unpack there, Mr. Norfolk. Well, we'll keep watching, and hopefully we can have this single window, at some point. It would be interesting, to see that happen in Nigeria. Thank you so much, Mr. George.
Thank you, Laddie.
Always great having you.
Always
right
great
here,
to be here with
NBCO
you.
Coleman Wires. Thank you so much. All right, we'll take a break now. When we come back, we move on to our next conversation. That's a moment. Just stay with us.